Hey, economic warriors, it's your boy, boss, back to slice through the steaming pile of nonsense the government and Wall Street want you to swallow. Today, we're diving into the latest market meltdown, Wall Street traders getting spanked harder than a toddler in a candy store, and Main Street left holding the bag. Spoiler alert, your government's fingerprints are all over this mess. Buckle up, because we're about to expose the economic clown show, from tariffs to tightwads at the Fed, and why you, yes you, are paying the price for their incompetence. Let's go. Alright, let's set the stage. This week, Wall Street traders got absolutely wrecked. We're talking the biggest cross-asset losses since the Federal Reserve's monetary tightening campaign peaked in 2023. Stocks, bonds, currencies, everything got smoked. The S&P 500 is down 6% from its peak, the Nasdaq briefly hit correction territory at 10%, and a jaw-dropping $3.7 trillion in stock market wealth just poof, gone, evaporated, vanished into thin air. Major ETFs tracking stocks, treasuries, and corporate bonds. Down an average of 2%, marking the worst cross-asset sell-off since October 2023. And here's the kicker, folks, this isn't just some Wall Street sob story. This is your story. Why? Because of something economists love to call the wealth effect. When markets are flying high, people feel rich, they spend, and the economy hums along. But when markets tank, like they are now, people tighten their belts, cancel that vacation, skip the new car, and boom, the economy starts coughing up blood. Mark Zandi, chief economist at Moody's Analytics, dropped a bombshell: for every $1 decrease in net worth, consumer spending drops by 2 cents. Sounds small, right? Wrong. With $3.7 trillion already wiped out from stocks, that's a potential $74 billion hit to consumer spending. And guess what? Consumer spending makes up 70% of US GDP. You do the math, this is a recipe for disaster, and we're just getting started. So, who's to blame for this dumpster fire? Oh, let me count the ways, starting with the government's favorite new toy, tariffs. This week, we saw a volley of confusing, contradictory tariff announcements that sent markets into a tailspin. One minute, it's tariffs on everything. The next, it's just kidding, maybe not. Investors hate uncertainty, and this administration is serving it up like a buffet at an all-you-can-eat clown convention. Here's the deal, tariffs are a tax on you, the consumer. The U.S. Chamber of Commerce estimates that Trump-era tariffs already cost American households $1,300 per year in higher prices. And now, with threats of even broader tariffs, like a potential 25% tariff on all imports from Canada, our largest trading partner, prices for everything from cars to groceries are set to skyrocket. The Peterson Institute for International Economics projects that such tariffs could shave 1.8% off U.S. GDP by 2026. That's right, folks, your government is literally taxing the economy into a recession. But wait, there's more. Let's talk about the Federal Reserve, the geniuses who spent 2023 jacking up interest rates to fight inflation and are now sitting on their hands while the economy teeters on the edge. Fed Chair Jerome Powell had the audacity to say on Friday that officials don't need to rush to adjust policy, even as bond traders are screaming for rate cuts. Are you kidding me, Jerome? The yield on the 10-year Treasury note just spiked to 4.5%, the highest since May 2023, making borrowing more expensive for everyone, from homebuyers to small businesses. And here's the cherry on top, while the Fed dithers, the labor market is flashing red. The latest jobs report showed just 12,000 jobs added in October 2024, the weakest since December 2020, and unemployment ticked up to 4.1%. Housing? Forget about it. The National Association of Realtors reports that existing home sales are at their lowest level since 2010, with mortgage rates hovering near 7%. This isn't just a market correction, this is a government-engineered economic train wreck. Now, let's zoom out and talk about why this market meltdown is a 5-alarm fire for Main Street. Remember the wealth effect? It's not just some fancy economic jargon, it's the lifeline of this economy, especially in today's top-heavy business cycle. The richest 10% of American households account for nearly half of all consumer spending, according to Moody's Analytics. And guess what? Those folks are older, often retired, and hypersensitive to their stock portfolios. When the market tanks, they don't just cut back on caviar, they cut back on everything. Here's a terrifying stat: the rise in U.S. total net worth since 2022 has been almost entirely driven by stock holdings, especially tech stocks riding the AI hype train. Strip that out, and net worth would be flat, according to Gavco research. Flat. That means the average American's financial health is tethered to a stock market that's now overvalued and teetering on the edge. And let's not forget the little guy, the speculative traders who got crushed in this meltdown. Leveraged ETFs tied to single stocks like Tesla. Down over 50% in some cases. Crypto. Oh, don't get me started. Digital assets, which peaked at $3.7 trillion, are the wild west of finance, and young, inexperienced investors just got a masterclass in pain. Peter Atwater from Financial Insights called it a traumatic financial event, and he's not wrong. A study last year found that every dollar of unrealized crypto gains led to a 9-cent increase in spending. Now imagine the reverse as those gains vanish. Here's where boss economics world gets spicy, folks. This isn't just a market correction, this is a policy failure of epic proportions. Let's break it down, layer by layer, from point to surface, just like peeling an onion of incompetence. 1. Tariff tantrums. The government's obsession with tariffs isn't just bad economics, it's economic vandalism. The American Enterprise Institute estimates that tariffs imposed since 2018 have already cost the U.S. 142,000 jobs. And now, with threats of even more tariffs, the National Retail Federation warns that consumer prices could jump by 10–20% on everyday goods. Who's paying for that? You are. 2. Fed fumbles. The Federal Reserve's tight money policy is like trying to fix a broken leg with a sledgehammer. Sure, inflation was a problem, but now, with inflation cooling to 2.6% in October 2024, per the Bureau of Labor Statistics, the Fed's refusal to cut rates is choking the economy. Small businesses, already struggling with higher borrowing costs, are laying off workers at the fastest pace since the pandemic, according to the National Federation of Independent Business. 3. Fiscal folly, and let's not forget the government spending spree. The national debt just hit $36 trillion, according to the U.S. Treasury, and interest payments alone are now eating up 15% of the federal budget, more than defense spending. This fiscal irresponsibility is crowding out private investment and fueling market volatility. The result? An economy on life support, with consumers tapped out, businesses battered, and markets in meltdown mode. And what's the government doing? Throwing more tariffs on the fire and pretending everything's fine. This isn't just mismanagement, it's malpractice. Now, let's talk about the elephant in the room. Are we heading for a recession? Ed Yardeni, the famous economist, says it'll take a lot more than a 6% stock market drop to derail GDP, and he won't worry unless the S&P 500 falls 20%. Fair enough, Ed, but here's the problem: markets don't need to hit bear territory to cause real damage. Doug Ramsey from Luthold Group warns that this economic expansion can't survive a stock market correction of more than 12–15%. We're already halfway there, folks. And the data is not on our side. Consumer spending is slowing, with retail sales growth dropping to just 1.3% year-over-year in October 2024, per the Census Bureau. The housing market is a ghost town, with affordability at its worst level in decades. And don't forget the labor market, those 12,000 jobs added last month. That's a rounding error compared to the 200,000 plus jobs we were adding earlier this year. Here's the scariest part: markets have the power to cause economic trouble, not just reflect it. A prolonged sell-off could trigger a vicious cycle: less spending, more layoffs, lower confidence, and bam, recession city. Bloomberg data shows that a 20% stock market drop preceded or coincided with a recession in 11 out of the last 15 cycles. We're not there yet, but with the government pouring gasoline on the fire, it's not hard to see how we get there. Alright, economic warriors, here's the bottom line: this market meltdown is a wake-up call, and the government is hitting the snooze button. Tariffs, tight money, and fiscal recklessness are a toxic cocktail, and Main Street is the one getting drunk on the pain. Wall Street's losses are bad, but the real story is the ripple effect: your spending, your jobs, your future, all under threat because of government incompetence. So, what can you do? First, get mad. Demand better from your leaders. Second, get smart. Protect your portfolio by diversifying, don't bet the farm on overvalued tech stocks or crypto moonshots. And third, stay tuned to Boss Economics World, because we'll keep calling out the clowns in Washington and Wall Street, no holds barred. Until next time, keep fighting the good fight, economic warriors. This is your boy, the boss of economics, signing off. Peace out.